Welcome to another episode of Rich Doc Poor Doc. Today, we're going to talk about the 7 reasons why we think cash flowing rentals are the best alternative income stream to your day job.
Right. And right now, it's really important to be talking about this, right?
Yep.
With the COVID and the downturn, I think more than ever, people have realized that they can't just have one income stream anymore. It's not safe. And we've been, thinking about this for years now. We've been talking about it. We've been thinking about it in terms of a table and having multiple streams of income, each our leg of that table. And hopefully at some point we'll get up to more like 7 or 10 streams, but I can think of at least 3 or 4 that we have at this point. And so, what we really wanted to talk about today is why real estate can be such a big stream of income for you, and why we love real estate more than a lot of the other alternatives out there that can be a monthly cash flow income.
Yeah, and I think we should talk about this in terms of like it's not just a it's not just a small stream of income. It's not a side gig, right? It's not like you're doing surveys and you're making, a couple $100 a month. We're talking about substantial income and actually tax savings, which we'll talk about, which rivals your clinical income or your day job. And so that's the type of income that we're talking about. And again, the idea here is that just like the legs on a table, if you can't support your family with your one job, right, you need to have another leg of that table to hold that up. And ideally you have a third, because it's going to be pretty hard to hold up a table with just 2 legs. And so the idea here is to continue to add to your uh, income streams if you can, and we think real estate is one of the best ways to do that. And so today we're going to kind of run through 7 reasons why we think real estate is the best alternative income stream. And so we're going to kind of run through this list. And number one is cash flow. And I'm going to have Late T talk about cash flow.
Yeah. So for those of you out there who haven't heard much from us, cash flow is basically when you put money in your pocket after all expenses every single month. And so if you have a cash flowing rental, the idea, at least for us, is the basic minimum should be 10% cash on cash. And what that means is, let's say you put $50,000 into an investment property as a down payment. We want to make $5,000 a year in cash flow. And again, that's after all expenses, insurance, property management, everything. So cash flow is so important because it does form that source, that major pillar of income, and that's what you're putting into your pocket. And the importance of it is it just gives you this sense of freedom when you have it. I mean, even if it's like just $10,000 or $20,000 in cash flow, which is actually tax free, and we'll talk about that later, that allows some flexibility in your schedule, and it changes your mindset when you know that you have other ways to make money.
Yeah, generally we don't rely on this money to live, right? We still have our day jobs. The idea here is that, if you were to lose your day job or lose that income stream, or, let's say it gets cut in half, right? And well, the idea here is that, you can live on that if you have to. What we tend to do is like we just reinvest it. And that's kind of how our wealth grows very quickly, is because that money is kind of compounding. And I also did kind of want to mention that 10% cash on cash return is kind of like a starting point for us. We always try to think about how can we increase the income, rental income, how can we decrease expenses, and we try to really shoot up that cash on cash return as high as possible. And in fact, we have one property that's running at 40% cash on cash return. So this property, I mean, pretty amazing if you think about it. I mean, we actually only invested about 45,000 on a $160,000 duplex, and it's actually netting us 20,000 in cash flow per year. And so we're going to make our money back in less than 2.5 years.
Yeah, that reminds me of an article I wrote about how one rental doesn't bring you financial freedom, but it sets you free, because even, one rental gets you that first step towards seeing those returns. And then after you get your second, third, and fourth, that's when you feel that change, that you can feel that you have a significant source of income that's then allowing you to live the life you want and work in your day job as much or as little as you want. So okay, so number two, let's keep going, is tax benefits. So Kenji, take it away.
Yeah. So, when we talk about tax benefits, we talk about it in two different ways. There's two different forms of tax benefits with cash flowing rentals. And the first one, Leti had mentioned that the cash flow is oftentimes tax free. And what that means is that even though you're putting money in your pocket every month, when you file your taxes, you actually generally show a loss. And the reason is that there are with real estate, you can actually have paper losses in the form of depreciation. And you can also shift other expenses into the business, like let's say phone and internet that you're using for the business all the time. Before, you used to be paying it out of your own pocket, out of your personal expenses, and now you're having the business pay for it. And so that's another example of how you can shift expenses or create paper losses. And what happens at tax time is that you show a loss. So that's kind of one form, right? So like cash flow being tax free, that's a huge benefit, because if you're making 100,000 in cash flow, that may be equivalent to 130, $140,000 in W-2 or 1099 income. And now the second benefit is really unique, I think, to real estate, and also a huge benefit that only if you claim, you can only get this tax benefit if you claim real estate professional status. And we'll talk more about real estate professional status in future episodes. But in brief, what it is that if you can take whatever losses from your real estate and you can use that to shelter other income like your W-2 or 1099 income. And so what you can do here is that you can actually set up a situation where you generate enough losses from your real estate and shelter all of your W-2 or 1099 income. In our situation, I'm the real estate professional and I don't work clinically as much in order to achieve that status. And and then we use that to shelter all of Leti's clinical income, and also our blog income as well. And so we've been doing that for a number of years.
Yeah, that makes a big difference when you don't pay any income taxes because you can take that money, recycle it back into more properties, and you can grow your wealth that much faster through compounding. So it's a big deal. So, number three is leverage. And what this is with real estate, when you go buy a property, you usually use a bank loan, right? And that bank loan is paying for a majority, usually about 75% of the property. And so your money goes so much farther in real estate than it does, for example, like investing in the stock market where you just put in their money and you make money on the money you put in. Now you're making money on the bank's money, which is a big deal. And there are really two major ways that you make a lot of that money on the bank's money. Number one is when you have gains. So let's say there's market appreciation or forced appreciation, and your property gains $100,000 worth of value. Well, that actually is all yours, right? It's not the bank's money, it's all for you. So you're making money on your bank's money that way too. And then there's also depreciation, which Kenji had mentioned. And what depreciation is the government sees your building as losing value every single year. Even though it may be gaining value, that's what the government says, is that your property loses value every single year. So the key with that is you actually get to depreciate the whole value of your property. And the whole value is 75% what the bank put in. So again, you're taking depreciation on the bank's money. So the bank's money is making you money. And that tax benefit is a benefit you take right up front, that puts basically tax money you would have paid back in your pocket.
Yeah, and leverage is something that you typically in something like the stock market or bonds, you're not going to get that type of situation where you can grow your wealth with somebody else's money. So I think that that's definitely one of the unique things about cash flowing rentals. So let's talk about number four. Is one of my favorites is called business systems. And so what does that mean, business systems? Well, so Leti and I have done a number of different startups, and when we built those companies, you had to we actually built products that just brand new products that nobody had ever heard about before. So we had to kind of educate people on those products. We also had to kind of train people to help us develop the product and also sell the product. And then also, we also had to kind of create systems and processes in order for us to be able to, run the company efficiently. Well, with real estate, what's cool is that all these business systems are already in place. So, for example, the product is the rental property. That's the product, and you don't have to explain that product to anybody. Everybody knows what you're selling, and then also the customers are all they're readily available. Everybody needs a home. So that part of it is really great because you don't have to start from scratch like we did. And then the next one is people. And if you think about all the people that you could hire, you don't have to train, for example, property managers, contractors. You don't have to train lenders, insurance agents, right? They all know what they're supposed to do to help you manage your rental property. And so, again, the people are already there. And then lastly, processes, right? I mean, they're, whether it's kind of bookkeeping or keeping track of income and expenses, all that stuff is already in place. And again, that's one of the reasons why we love real estate. It's a business that's like kind of like a franchise where you can just get it up and running really quickly, and you can start making income from that property from day one, as opposed to when we started a company. I mean, what was it, 6 to 9 months before we actually made any revenue?
Hmm.
So completely different.
Right. And lower risk in a way too, because you're, it's a proven system that people have been using for generations to make wealth. It's not some business that you're creating out of scratch and hoping that somebody's going to take it. So it definitely is a different kind of system where you can make money. So the next one is that real estate can be passive or relatively passive. So, what I mean by that is, Kenji and I are very, very involved in our real estate portfolio. We're constantly thinking about it, especially Kenji, since he's our real estate professional. And we're always thinking about how we can improve our performance of our properties. We're thinking about how we can increase income, how we can decrease expenses. We're very, very involved on the daily basis. But it doesn't have to be that way. So, previous episode, we talked about Kenji's family and his parents who had bought real estate property. And I would use them as examples because your mom's really not that involved in her real estate portfolio. I think the only time she really probably deals with it is at tax time when she has to think about it. And so there is that availability. Now, I wouldn't suggest that because you're not going to be as profitable as you would have been if you were actually very involved in your properties, especially since you're not going to get real estate professional if you're not actively involved in doing material participation hours. But it is always an option to be less involved in your real estate. And the beauty of that is that you have the ability to kind of flex it up and flex down in terms of hours. So for example, if you were going through a really particularly busy time at work and, for 3 months, you were working 60-hour weeks, you could actually be less involved during that time in your real estate portfolio. Or, you could just choose in general to be less involved and put in minimal hours. So there's a lot of flexibility in the time, and it's very easy to have a full-time job and do real estate on the side.
Yeah, and I think for us, if we think about kind of where we want to take this long term, is that we want to keep building our portfolio, getting bigger properties over time. And at some point, I won't be a real estate professional. Maybe 10 years from now, let's say 5 years, 10 years from now, who knows? And at that point, I would love to. We would love to have like a large apartment complex where we can hire on-site management to handle the kind of the day-to-day affairs. And at that point, I think it'll become relatively passive as long as you have good managers, good people working in those offices. So that's really kind of the goal for us, is that make something that right now I'm choosing to make it not passive, and I'm very actively involved. And then over time, at some point, it's going to become um, almost completely passive.
Yeah, and the other point is some people choose to do more like commercial properties, like stores and like let's say having a Walgreens that you're renting to, and that's much more passive. So even within real estate, there's actually a degree of passivity based on what you choose as your niche. Whether or not you want to do large multifamily, you want to do storage units, you want to do any sort of other things.
All right, let's talk about number six, tangible assets. So, can you talk about that? What that
Yeah.
means? Because I know you like that
I
topic.
love that. So the reason I love it is I love the ability to know that I have properties, not just that my money's in the stock market and somebody else is, responsible for whether or not it makes money. I love having the control. I love thinking about my properties and knowing I own them and knowing that I can improve their performance as much as I want, and that, if all goes to hell, I basically have some buildings, and some land. It's a big deal for me emotionally.
Yeah, and if we think about all the non-tangible assets out there, like let's say Bitcoin or or even kind of like stocks, right? Okay, I mean, like, okay, maybe you might be presented with a physical stock certificate at some point, but generally it's all electronic. It's not real. It's not tangible. It's not something you can go up to and drive up to and touch and feel. And so, yeah, we love the tangible aspect of real estate for sure.
Yeah, I think about also, we met with a landscaper yesterday, for example, and he was saying, well, he owns a property, and if worse comes to worse and his retirement falls apart, he could always move into that unit. And that's true for us too. We always have a place to live.
Right, right. Okay, well then let's move on to the last reason why cash flowing rentals are the best alternative income stream, and that is the fact that real estate is relatively uncorrelated with the stock market.
Yeah. So that's also makes me very excited. So I mean, the thought is, and we learned a lot about this in conference we went to in February, is that you want multiple uncorrelated assets, just like we were describing, having multiple sources of income that are unrelated to each other. And so if one asset goes down, like let's say the stock market drops 30%, like it has, then your real estate is unrelated, untied to the stock market, and it can maintain. Same idea with like we've been investing in small startups, higher risk, but completely uncorrelated with the stock market, for example. And so the idea is that real estate just allows you to diversify over just having all of your money in the stock market.
Yeah, it's not to say that real estate's not correlated with the stock market, but there are certain asset classes, real estate asset classes, where with the stock market, eventually the real estate does also go down. But if you kind of invest in some more recession resistant classes, for example, multifamily properties, which are more working class, we call them B or C class multifamily properties, things like mobile home parks or storage facilities. I mean, these are considered more recession resistant classes to invest in. And so, I would actually say with BC multifamily, uh, during the last recession, I actually owned a couple of these properties, and my rents actually went up during that time, and the value of those properties actually went up during that time because the demand for those properties was so big, because all the A-class properties, which I also had, and they suffered. The people who were living in those actually either lost their homes or couldn't afford the rent, and so they actually moved into B and C multifamily, which actually increased the demand for those, and therefore the prices of those went up. So in that sense, I mean, it really was uncorrelated, and so I think that's a real benefit uh, if you have different assets. Again, not just real estate, not just stocks. This could be it could be gold, right? Precious metals could be another asset class. Bitcoin could be another one. As Leite mentioned, investing in startups could be another one. So lots of different asset classes that you can invest in, and the more uncorrelated, definitely the better.
Yep. I think that covers everything. So thanks for joining us on another episode of Rich Doc Poor Doc, and we'll see you soon.